TheoTrade. This is Don Kaufman. July 16th, 2021. Literally seconds to go to the cash close here on this Friday afternoon. The S&P's down some 33 handles, and markets clearly are in transition. We're going to explain that and much more on this weekend's update. First and foremost, a bit of recap of some of the action on the screen right now because, if you haven't been paying attention, it is going on right now. The S&Ps are down some 34 handles. The Nasdaq is off by about 0.8%. The Russell, once again, taking it on the chin, another 1.3% decline. But one of the things that is a bit perplexing, we're going to talk about, there's the closing bell. We're going to talk about here momentarily is the fact that volatility shrugging its shoulders at this. So as I said, let's get to work on this this weekend's update here with some sell side activity into the tail end of the week. One of the first things I think that's pivotal to understand that's gone on in the week, and again, this is pretty much the entire week at large, the market sold into dovish Fed speak. And if you're unaware of what I'm actually referencing, that has to do with the Jerome Powell testimony in front of the Senate. That testimony was extraordinarily dovish. In effect, what Jerome Powell said, okay, interest rates are going to be low for a substantial period of time. They're not even considering taking their foot off the accelerator in regards to the bond buying program, yada, 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 dovish comments. So why does that make a difference? I mean, we've heard dovish comments continuously. I'll tell you exactly why it makes a difference. Let's actually pull up a 9-month on the S&Ps. Some of the first times we've actually seen sell-side activity into those dovish comments. And it is a bit of transition to the marketplace, but it's not just the S&Ps that we're concerned with, okay? The bond market, well, the bond market, let me tell you, they bought into the dovish comments hook, line, and sinker. For the most part, what I'm actually referencing in this case, if we go over to the TNX, and this is actually the interest rate. Again, this is the interest rate on the 10-year, right? The interest rate is down quite substantially. And over the last couple of weeks, it's off the bottom, but we're sitting back at 1.3%. Again, I want to quantify that for just a moment because how far we have actually come in the last couple of weeks. We're back down to 1.3% in the 10-year off of just a very recent approximately 1.6%. That, on a percentage basis, is an absolutely massive decline. And it's just, again, it's one of the things that's not being discussed, I think, often enough inside of the marketplace. In fact, when you start to put this on a percentage basis, okay, the shift in the 10-year Treasury, this is the actual interest rate associated with the 10-year Treasury, is nothing less than monumental. For the most part, the rates were up about 100% and have now actually collapsed down. We're only up about 40% year to date on the 10-year Treasury. Again, shocking moves that you're seeing. But in the last 2 weeks, this thing has collapsed back down substantially again. That's one of the aspects of, the Fed comes out, they're dovish. What do the interest rates do? Well, they agree. They said, all right, Fed's dovish, we'll be dovish. So they back off the interest rates. But at the exact same time, it's like the marketplace is caving in that, all right? And the marketplace is literally saying, okay, the rates are going to be lower. Well, there's actually sell-side activity. Could actually be an indication. Not only, people are talking about transitory, non-transitory, push that aside. What this could be indicating is slower growth, right? Slower growth into the future. It's one of the reasons that the Fed remains dovish. So a few weeks ago, we mentioned that Goldilocks kind of marketplace felt like it was kind of evaporating underneath us. And here we are, just a few weeks later, the market literally sold into dovish Fed speak. And that, again, is one of the most critical takeaways of this entire week. And we'll see, there's always comments coming out of the Fed. Nevertheless, we'll see what rates do. On another basis, a completely different front, and I'll come back to bonds here momentarily, on a completely different front, I want to bring up the Nasdaq. And in this particular context, I want to talk a little bit about the Nasdaq futures. And again, as I've said, at the beginning of this, the market is in transition. One of the transitions that I see right now is going to be a major expansion of price action. And that price action, it's already changing inside of the Nasdaq. So I'm showing you Nasdaq futures. Just take you into a couple aspects here. All right, Nasdaq futures. First and foremost, I want to hide the volume. So I'm going to come over here, hit the little sprocket. So when I hit the sprocket, come over here to futures, and under futures, show volume subgraph. We're going to get rid of that because I want to make this as clear and concise as I possibly can. All right, next we're going to come under studies. Under studies, I'm going to go ahead and add study. And one of the studies, and this is one that I just do not pull up, an incredible amount. One of the studies I think that begs to be pulled at this point in time is historical volatility. So I've been talking about this quite a bit lately while live on TheoTrade. We've touched upon it on some of the evening videos, but I want to hammer this home right now. This is a 9-month on the Nasdaq. Okay, it's a 9-month on the Nasdaq. Forget about the chart for a second. I want you to look at, again, historical volatility. In fact, I think it's so important to see this that we're actually going to drag it up on the screen because this is where it's at right now. When it comes to historical volatility, the historical volatility that you're looking at right now is, again, this is a 9-month, this is a daily chart, but this is the 20. So it's literally averaged over the last 20 days. Well, in the last 9 months, this is absolutely unequivocally the lowest historical volatility that we've seen. So what does that really mean to you? It means it's the annual, it's the standard deviation, okay, of past stock price movement. That doesn't do you any good. What we're talking about is actual price action in the Nasdaq. Bottom line, the Nasdaq, get ready to rock. This thing's going to move. It's going to move huge. And one of the things that you have to put in perspective, okay, 100-point move. That ain't big. That's still only a 0.8% move. All right. You now have to have 150 point NASDAQ moves to see a 1% move. Okay. We're going to talk about be aware of percentage moves here in just a moment, but you got to have a 150-point move in the NASDAQ for a 1% move. And we've all seen in recent history 3% type moves inside of the NASDAQ. So what am I saying about the Nasdaq? Get ready to rumble inside of the Nasdaq. Now I'm going to take this because I want to show you something that I found even more entertaining. We're actually going to take this particular study and we're going to tweak it. How are we actually going to tweak it? We're going to come in here and we're actually going to edit the parameters, and we're going to take it from the 20 and I'm going to knock it down to just, okay? And I'm going to average this out just the last like 5 trading days. And again, you can toggle this down. You can type in 5. Hey, whatever floats your boat. Hit apply, hit OK. Okay, you're about to see a wild spike higher in terms of NASDAQ price action. Get ready for it. It's already being implied as well in the option marketplace, but I cannot stress that enough. Historical volatility in the NASDAQ, you're about to see some wild movement on there. And you know what? That I don't want you guys to take that away as a bearish connotation for the marketplace. Again, I'm telling you that you can feel that markets are in a transition. And I'm going to be very frank in saying we're not entirely sure what that's going to look like on the other side, other than, and this is the one thing that is definitive, it is going to be met with fairly extreme volatility. That, okay, is first and foremost. I can't tell you, a month from now we're going to be higher, we're going to be lower, but I can tell you, you can see the transition, the internals and everything, which I'm going to discuss here momentarily. All right, there is a dramatic shift in trade in literally the last few weeks. Okay. So what do we know here? We sold into, again, a dovish Fed speak. We've got price action that is going to pick up in a big way inside of the NASDAQ. And if you don't believe that, just look at the NASDAQ over the last 2 to 3 days. Volatility has yet to come up, but the VVIX is actually bid. This is one thing that I'm a little bit perplexed by. So again, as I titled this this weekend update, markets are in transition. That transition has not been met yet with extreme volatility. So, volatility, it picked its head up off the floor here, but an 18 VIX is not exactly getting it done. And that's probably because the percentage moves we're seeing are nominal. Again, we're going to mention that here momentarily. However, at the exact same time that I'm actually saying, volatility has been kind of a nothing burger. Yeah, until you look at the VVIX. That's concerning. Why? This is the volatility of the volatility index. The volatility of the volatility index is effectively, okay, it's options that are being traded specifically in what? In VIX. Okay, so let's go take a look at VIX. Let's open up the option statistics. And what you're going to see in option statistics, there is a proverbial crap load of options that have been trading today. And I'm going to tell you right now, the market in there is pumped. The volatility has picked up in the VIX itself, which is indicative of hedging activity. So you're looking at the VIX and you're like, well, the VIX hasn't really picked up. Yes, but those that understand, okay, are moving towards the VVIX, which is what? They're actually trading the options in the VIX, and the volatility of the VIX is actually flying right now. Again, cannot stress this enough. If you never looked at the VVIX before, this thing is ready to crack the 130 zone. Hold on for just a second here, because this, again, it can't be overstated. How high is 130 in the VVIX? Oh, how about we can count the number of times, okay? The number of times, well, in the last year, it's been a pretty wild, 16, 17 months since the onset of COVID. But I'm actually going to go up to like a 5-year, okay? Let's even erase this entire last year, okay? You've only got what? Three instances of the VVIX being this high in previous years. Obviously, okay, you need to pay attention to this right now. That's a 5-year, and by the way, I'm even going to take this out to the maximum. This is pretty much the whole history of the VVIX, and to be at this level, it's unprecedented. And that is actually one of the standouts over here because when I call the markets in transition, what's the transition? Don't know yet, but I do know one thing: the VVIX is skyrocketing in here. Okay, historical volatility in the Nasdaq, that's coming up. We're selling into dovish Fed speak, which again is opposing to what we've seen lately. All right, now we're actually going to come over to the bonds. All right, the bonds. All right, let's take a look at the bonds, and we're actually going to start inside of the TLT, and I'm going to pull up auto expected moves because I want you to see how dramatic some of the moves in the bonds happen to be. Okay, bond rally implications are only beginning to materialize. So the bonds not have just rallied. One of the great ways I think to look at markets. Forget that this is even the TLT for a second. I'm serious. It doesn't even matter that it's a TLT. I'm going to close up this left side bar. I'm not a big chart guy, but you really have to appreciate what you're seeing on the screen right now. And I wanted to spend some time on this weekend update going into this. And I've talked about this a few times before, but look at the last couple of weeks. It is a bond market, but look at the last couple of weeks. Cracked an expected move, cracked the expected move. And we're not just talking, broke through. At the end of the weekend, it broke through the expected move. Cracked the expected move, cracked the expected move, cracked the expected move. This week, lo and behold, finally we're inside the expected move. Again, you got 1, 2, 3, 4, 5 weeks in a row. But almost every recent week inside of the TLT, you're hitting the upper, lower edge of the expected move or completely smashing through the expected move. And again, no one's talking about why are the bonds rallying? Why are the bonds rallying? Okay. And that's where you should think about this in depth. It is, the opposite of what you would have expected. If there's going to be inflation, right? Shouldn't the bonds maybe be selling off to kind of try to maybe curb some of that inflation? Or is the marketplace, and you can look at this a couple of different ways. Why are we buying bonds? Is there just so much cash out there that we just have to flood into every single asset class? That could be a possibility because we've actually heard some tremors going on in some of the overnight funding. And I don't want to get too much into collateralized debt and so forth, but to push all that aside for a second. Anyway, you've been hearing how much capital is actually out on the street and there's distortions going on. So one of the things you could say, all right, well, there's just so much money out there. We have to buy anything pretty much at any price. Sure, you could say that. You could also turn around and say big money right now is moving towards bonds because they're looking at the S&Ps and going, this is ridiculous. Why am I even bothering buying the S&Ps? They're at 4,315. Okay, it's buy anything at any price. I'd rather throw my money in bonds and make absolutely nothing than take risk in the S&Ps. Yeah, you could also use that one. Or, okay, third is, hey, maybe the bonds are actually pricing in slower growth to the future. Okay, whichever way you want to look at it. Buying bonds presents a very substantial problem, okay? Because the implications are only beginning to materialize. What is the bottom line of all of this bond buying? I'm going to tell you, it takes rates lower, and rates lower should absolutely damage the financials. Is it starting to damage the financials? Well, possibly. The financials have clearly been on a downtrend. That downtrend really kicked off all the way back here, which is early June. Here we are towards mid-July, or 6 weeks of some sell-side activity. But I'm going to tell you right now, as I said, it's only beginning to materialize. If I bring up auto expected moves, look, the XLF closed on the lower edge of the expected move. Okay, neither here nor there. Next week, it's pivotal stuff. Okay, I would expect, yeah, maybe the financials try to bounce, but the financials selling off unequivocally pulls the S&Ps down. Okay, not even tech can save us at that point, and that's exactly why, I was talking a little bit about, Fed speak. How come I didn't go and talk about bonds then? Because bonds right now, completely different animal. It's just a completely different animal right now. I don't want to wrap the Fed, okay, around the bond market at this point in time. The bond rally implications, okay, we're just seeing the forefront of it, but nobody is paying enough attention to the sheer magnitude of the moves inside of the bonds. A little violence in bonds is going to go a long way. This is massive institutional capital that is on the move. And ironically, today, the bonds finished massively unchanged on the week. Nevertheless, okay, we are up there, people. I mean, the bonds are absolutely flying in any way you want to shake this, okay? In any way you want to present it, it is, again, only at the forefront. The risk is starting to materialize around this, and we expect, again, a lot more volatility coming forth to the S&Ps. Why? Because we're in transition, and we're seeing the beginning of the transition really kick off inside of the bond market. Okay, next, again, completely different theme over here, market internals. If you trade on an intraday basis, I want to show you that market internals, we are a broken bunch. On an intraday basis, there is no feel. Sell side activity just literally comes out of the blue this morning. You realize the S&Ps were bid this morning by the tune of 15 handles. That means the S&Ps were up 15 points. Okay, marketplace opens, we start selling off a little bit, moderate for a period of time, and we just go for it. All right, slow, like this is methodical. I mean, it's just like sinking into a warm bath of selling, which again, that's all well and good. But what am I talking about with market internals not really functioning? I'm going to get to the specifics of that. One of the things, if you take a look at stuff like volatility futures, here, okay, you need to only look. The volatility futures barely moved, all right, with some sell side activity this morning. Again, right in here, the S&Ps were up 15. All right, the volatility futures barely moved and then slowly rallied up. That's just one of the internals that I would look at, right? Next on that particular front, if you look at like advanced decline line, like, oh, the advanced decline line's negative. Yeah, but in the most hostile selling today, in some of the most hostile selling, the advanced decline line was like 50-50. I mean, the bottom line, again, everything on my screen that matters is kind of down. But you look at this and you look at the advanced decline line, and those two didn't make much of a difference. I also look at something called Quantix. Okay, and this is looking again, and I'll get really specific over here. This is actually looking at a cumulative tick. All right, and if you look at this TheoTrade comparative Quantix right here in green, that happens to be the Russell. The Russell tick was actually wildly positive today. Meanwhile, the Russell completely fell out of bed. And again, its tick was wildly positive and descended lower, but still ended the day strong relative. Okay, the point being over here, some of the internals are, again, they are not functioning. And by the way, I could spend hours just talking about market internals right now, but they're just not functioning. You have to be extraordinarily careful on an intraday basis because we're seeing an expansion of actual price movement, like I mentioned in the Nasdaq. We're seeing in market internals that don't feel right. Right? I'll give you another market internal that doesn't feel right. When was the last time you saw bonds flat? Okay, but the financials actually down 1.37%. Doesn't make a lot of sense, right? You would assume that the rally in the bonds would have continued and the financials are selling off because the interest rates are going, what, lower? Not the case here. Market internals are all over the place, all right? How come we have the energy sector getting smoked by the tune of almost 3%? Where's oil today? Oil, well, almost unchanged on the day. Again, sector rotations, we have some unusual occurrences here. Take a look at the auto expected moves. When it comes to the energy sector, when I say this thing got smoked, I'm not playing around here. The energy sector last week was outside the expected move. This week, this thing got decimated. This is 3 sigma territory. That's right, people. The infamous 3 sigma is showing up inside of the energy sector. Where'd it come from? Again, no movement in the bonds. The financials came off a little bit, and yet the energy sector doubles the losses over there. And again, we can kind of surmise like, this reason, that reason. No, it's just, again, the possibility of even a rolling bear market kind of comes to mind in here because the sell side activity, it is that great. The energy sector is up and was up almost 50% in a year-to-date basis, now only up 28%. Keep eyes on this as days to come because the energy sector, it's not that large, but that kind of sell side activity is actually causing damage again to the S&Ps. All right, onward and upward from there. This is another really critical aspect. One of the things I want to focus on for just a moment. Okay, you got a 35-point move today in the S&Ps. What does it mean? Absolutely nothing. It's 0.8%. Okay, stop getting ahead of yourself. I said this a moment ago with the Nasdaq as well. Nasdaq, 0.8% move. You have to get a 150-point move in the Nasdaq to see a 1% move. The S&Ps, come on, you got to be moving 40, 50 handles to see like that 1% move. So you need a little bit of perspective because markets at this point, they've been running up. And again, let's actually bring up the S&Ps, if you will. Markets have been on a straight tear. Okay, and let's just put it where it's at right now. They've been on a straight tear since literally November 1st until right now. Okay, yeah, well, the last time we sold off, we were at 3,200. Now, if we're going to sell off, we're at 4,300. It's 1,000, S&P points straight up, but it changes everything. Be aware of percentage moves because when the marketplace starts to move, 3% plus moves are what one would say is statistically significant. Okay, so what's a 3% move in here? Well, it's a $4,300 product. Let's just go boop, 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 about 120 points. You can easily see a 120-point move inside of the S&Ps, okay, easily on a day-to-day basis. It's one of the things that people are not paying attention to, all right? What would then be, a 1% move is 150 points inside of the Nasdaq. You're talking about a 3% move in the Nasdaq, okay? You're looking at moves between anywhere from 400 to 600 point moves inside of the Nasdaq. Yeah, that would be par for the course. You got to pay attention to that. All right, last, okay, but definitely not least in this line of events where I'm saying that the market is in transition, spuz are evidently testing lower. That doesn't actually mean a tremendous amount. When I say spuz are testing a little bit lower over here, I mean today into the cash close, well, there was a little bit of fierce sell side activity. The volume didn't exactly get too extreme, but we definitely feel like we're starting to test a little bit lower. The reason I threw that in there though is simply the S&Ps are not going down, okay, unless we have the financials getting rocked. Well, the financials, they're pretty much holding on to the 36 level like it was grim death. And the reason I wanted to throw that in there, the spuz are testing lower. You're going to need the financials to get smoked early in the week, and then literally tech would follow. Earnings at this point, I know that earnings are coming out. I know big league earnings are coming out. Netflix kicks off next week in terms of tech. It's the week after that, though, when the big boys of tech are actually going to release. I think you should push aside earnings right now. We're transitioning. We're not going to wait. Next week is absolutely going to be pivotal for this marketplace. But as the spuz are testing lower, we actually hinged in very large part once again in the financials. Now, clearly, people are looking at tech. They're like, no, tech is carrying this. Okay, tech carried the last like oomph in terms of the S&Ps to the upside. But prior to that, this marketplace was predicated and wholly dependent upon, again, look at the move inside of the financials. On a year-to-date basis, the financials are still up 24% on a year-to-date basis, right? Where's the QQQ? QQQ is only up 15%. So when I say that the financials are pivotal, I mean it. The spuz are testing lower, but it's the financials that could snap the back of the broader S&Ps. All right, finally, we come to the SPX, the mother of all products, as we mention each and every week here, the expected moves. The expected move, okay, of the week that we just passed through was approximately $61. In effect, we were looking for this move, okay, that was $61 higher or $61 lower, right? Did we get it? No, but we reached for it today. Incredibly, incredibly close. I mentioned this on Wednesday night's video that we were unchanged in the week and you should expect volatility to really kick into high gear, and high gear is exactly what we saw, okay? What are we anticipating for next week? And this is where, again, we just closed moments ago. We're going to go into the SPX. We're going to go exactly 7 days out. I'm going to knock down the number of strikes. From a $61 move, you're now all pumped all the way up to 73 and change. Okay, so we're going to be sitting on about a $73 expected move. So the marketplace is already anticipating more volatility. I'm going to tell you right now, strap in. This next week is actually, as I said, it's going to be a pivotal week inside of the markets. We're testing lower. A lot hinges on the financials. I know everybody's got their head stuck in tech land, but the bottom line with the Nasdaq is look for considerably more movement. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.